दरअसल राहुल गांधी ने जानबूझ के उनसे कहलवाया कि तुम विरोध करो, मैं समर्थन करूंगा।
भाई मेरे को
Crentes.
నీ ఇప్పుడు నా వద్దాను అదే
నువ్వు కావాలని చెప్పాలి
पापा केड़े वाला हेडफोन देना बड़ा करोगे तो ये ऐसा रेड सिंबल आएगा। यहाँ पे मूव करो।
है तरुण खेलेंगे जाय
Good evening and welcome everyone. We still have some participants joining in. I propose to give them a few minutes and then we will start the session, please. Thank you so much.
आ रही है। हेलो। Good evening and namaskar everyone. This side Sanjay Suman from ICMAI RBO. Welcome to our program, Diploma in Valuation course. So today's our guest faculty and our MD sir is joined today and he is explaining the what is the use of business valuation. He is explaining full detail of this course. So I'm welcoming to Dr. S.V. Gupta sir for this
Thank you.
program.
Thank
Welcome
you.
sir. Good evening.
Thank you. Thank you. Good evening. Namaskar and welcome to everyone to this
evening, sir.
Diploma in Business Valuation course being offered and organized by ICMAI Registered Valuers Organization. Let me first give a brief about our organization. This is a Section 8 company, ICMAI Registered Valuers Organization, which has been set up and promoted by the Institute of Cost Accountants of India. And the Institute of Cost Accountants of India is a statutory body set up under an Act of Parliament. The institute is under administrative control of the Ministry of Corporate Affairs. ICMAI Registered Valuers Organization is a subsidiary company of the institute, which is focused on professional development and building up the valuation ecosystem. And this is pursuant to the provisions of the Companies Act, as well as the company is also recognized by Insolvency and Bankruptcy Board of India. Brief introduction about myself. I'm Dr. S.K. Gupta. I'm a postgraduate in commerce, a cost accountant, a company secretary with a PhD in corporate governance. I have spent over 43 years in the corporate sector in both public and private sector organizations, and I've worked in the domains of valuation, finance, internal audit, cost and management accounting, company secretarial functions, and have handled mergers and acquisitions and financial reengineering. Currently, I'm the managing director of ICMAI Registered Valuers Organization. Now, brief about this diploma course that we have planned and it's being offered by us. Valuation is required for very many different purposes across different sectors of the economy. Banks need to do valuation of properties, either taken as primary or collateral security. Similarly, valuation is also required under various regulations of SEBI. Valuation is also required under Ind AS. Valuation is required under FEMA. Valuation is required under EXIM policy of Government of India. And valuation, of course, is also required under income tax and wealth tax. And then, of course, a lot of provisions of the Companies Act 2013 require valuation to be carried out. And then we also have the Insolvency and Bankruptcy Code of India, Insolvency and Bankruptcy Code 2016, which also mandatorily requires valuation to be carried out. So there is huge potential and scope for professional opportunities in the domain of valuation. But let me make it clear here that according to the provisions of the Companies Act 2013, any valuation which is required to be carried out under the Companies Act or under IBC, Insolvency and Bankruptcy Code, can only be conducted by someone who is a registered valuer. Let me make it very clear. This diploma course will not allow you to become or will not make you a registered valuer. I'll come to that, how this course will help you, but I'm just trying to clarify any valuation required to be done under the Companies Act or under Insolvency and Bankruptcy Code can only be done according to law by someone who is a registered valuer. For becoming a registered valuer, you have to have minimum prescribed qualification, minimum prescribed experience, and then you have to also qualify an exam conducted by IBBI, and you have to also take up separate 50 hours of training course. So leaving aside those two areas where this particular diploma may not help, you will still not be able to do valuation under the Companies Act or under the Insolvency and Bankruptcy Code. But besides these two provisions, the field is vast open. Income tax, wealth tax, SEBI regulations, FEMA, CCI, Competition Commission of India, Ind AS, wealth tax, all these areas are open to you all to do valuation. And this course is going to help you build up your knowledge, build up your capacity and competence to be able to get assignments relating to valuation in those particular areas. If there are any questions, please raise. I'll be very pleased to clarify, answer any query that you may have. Before the start of the session itself, I just wanted to clarify, give you a background of who we are, what is our organization. So I told you a brief about that. I also introduced to you myself, gave to you a brief introduction of me. I also told you what is the scope of valuation in the marketplace, what is that you will be able to do after you complete this diploma course, and what is that you will not be able to do. Because there is a separate law which requires registered valuers to carry out valuation under the Companies Act and under IBC. But leaving aside those two domains, rest entire field is open for you to expand your practice, to expand and explore professional opportunities in the domain of valuation. So what we are going to do, and the way we have structured this particular course is, we are going to have online sessions, physical sessions. Maybe we will also provide you recordings of some of the sessions, which you can also refer to at your own pace, at your own leisure. But most of the sessions are going to be live physical online sessions. And we are going to take you through the entire sequence and structure of how valuation is carried out, starting with the overview, starting with the nature and concept of valuation, approaches, tools, and techniques of valuation. How can we use financial modeling, which is a very important tool and very effective tool for carrying out valuation. And then we will also tell you how exactly valuation is done in respect of certain particular specific companies and businesses. How to value a startup, how to value a fast-moving consumer goods company, FMCG company, how to value a company in distress, how to value intangible assets, goodwill, trademark, brand, how to value industries and companies in power sector, metal, and few other sectors for that matter. And the entire exercise and the entire session of learning is going to be hands-on, in the sense that we're going to introduce the basic concepts by way of a presentation, by way of a lecture session by faculty, and this will be followed up by practical hands-on experience provided by the faculty to you, so that you understand not only the theoretical perspectives, but also hands-on understanding and competence building in the domain of valuation. But then I again reiterate, any point of time, anytime, any one of you don't understand something which the faculty is talking about, please raise your hands. Please raise your voice. Immediately get that clarified. We are there to help you out to grasp the basic concepts. We know that some of you are professionals who are part of this group, and some of you may not have that kind of advanced knowledge or background with regard to valuation. We are aware about that. It's a mixed group sort of thing. So in order to help those people who may not have the right bandwidth or the right kind of level of knowledge currently, we would encourage you all to kindly raise your queries, ask questions from faculty. We will try to sort that out, provide you satisfactory answers to the extent possible. Going forward, we also want to provide to you study material based upon the entire syllabus that we're going to cover in this diploma course. We are going to provide you by next week online study material, which you can refer to subsequently. But we are also going to provide you a recording of each one of the sessions of the faculty, and as well as the presentations of each one of the faculty will be shared with you. What actually we'll do is we'll create a WhatsApp group today itself. My coordination manager will do that, and we will start posting everything on that group for the benefit of everyone who is connected with this course or who has joined this particular course. Besides the lecture sessions, we have also included a module or a component of project work. After you have completed your theoretical sessions, then we are going to give you or allot to each one of you a project, which you will have to do. Of course, we will provide all required guidance, no issue at all, but one project will have to be done by each one of you. And then there will also be an online multiple choice questions based assessment test, which you will have to clear so as to become eligible for grant of the diploma certificate from our organization. Don't worry, even if you have some problem not being available on a particular day or not being able to clear the assessment test in one go, we will provide you multiple chances, multiple opportunities. Don't worry much about that. Just focus on learning. And this is what is expected from each one of you. And that will also facilitate the faculties to provide to you the best of their knowledge and the best of their experience sharing in these particular learning sessions. So it's a very, very good thing that we are starting this course today on the auspicious occasion of Ganesh Chaturthi. So happy Ganesh Chaturthi to all of you. My best wishes. Namaskar. And that's where we start this session with a brief introduction about our organization, about the course structure, about the areas in which you will be able to do work once you get knowledge and get the hands-on experience through this particular diploma course. But I have made it very, very clear right in the beginning. Those two areas, the Companies Act and IBC, they are different. There you will not be able to do work because that is only permitted if you are a registered valuer. But leaving aside those two areas, rest of the field is open for you all, and you can explore professional opportunities in all those areas for that matter. So thank you so much with this brief introduction, and once again, a very, very warm welcome to each one of you for having taken this initiative of learning and joining this diploma course being offered by ICMAI Registered Valuers Organization. Just give me a second. Let me share my presentation on the screen, please, so that we can start the introductory session. Thank you so much. The overview of valuation. All of you will agree with me that the world is changing, and the world is changing very, very significantly and rapidly. बहुत तेजी से बदल रहे हैं. World is changing very, very significantly. It's a VUCA world. The business and economic environment today is highly volatile, very, very uncertain, hugely complex, and very ambiguous. And at the same time, it is also very, very competitive. It is hyper competitive. And at the same time, there is always that fear of uncertainty lurking at the back of our mind. You never really know what might happen 6 months down the line, 1 year down the line, or even 3 months down the line in the business and economic environment. In this business and economic environment of the 21st century, we have old gold-plated companies still existing in the marketplace, still sustaining. But at the same time, we also have large number of so-called new age companies or startups, which are mushrooming all across the world, including that in India. Some of the old age companies, they have lost their relevance and they had to go out of the market. Look what happened to Kodak, what happened to Xerox, what happened to Nokia. But we still have a good number of companies which are pretty old and they are able to survive and sustain in the marketplace even after so many different years that they have passed staying in the market and staying afloat in the market. So far as the startups are concerned, India today is the third largest startup ecosystem in the world. There are a large number of startups which are happening in every part, nook and corner of the country. Not only metropolitans, but tier 2, tier 3 cities, a lot of startups are happening. And some of these businesses today in 21st century have some very, very disruptive business models. To give you some examples, world's largest travel car company does not own a single car of its own. Uber. Look at the business model. World's largest travel car company, but they don't have a single car of their own. World's largest travel lodging company does not own a single hotel property. Airbnb, Oyo. World's largest retailer, Amazon, does not own a single brick and mortar store. These are amazingly disruptive business models, which were unheard of till about a few decades back. But these are the realities of the corporate world in 21st century. And the world is very different. The way the businesses function, the business models, the business processes, they're very different from what it used to be a few decades back or a few years back. When you look at the performance of the companies in the marketplace, you find that many companies have profitless turnover. They have a great top line, but end of the day, there is no profit. There are many companies. India today has over 115 unicorns. What is a unicorn? A company with valuation exceeding $1 billion US is called a unicorn. India has more than 115 unicorns as of now. And a new unicorn is getting added almost every fortnight, every month. But if you look at the performance of top 10 unicorns in India, only 3 out of 10 top unicorns in India are making profit. This is a very important statement. They are unicorns with valuations exceeding $1 billion US, but they are not making profit. Only 3 out of top 10 are making profit. 7 out of top 10 are incurring losses. And that's the characteristic of many of the companies in a marketplace today. Profitless turnover. Many companies have cashless profit. They have profit as per the profit and loss account, but they don't have cash. There's no liquidity. And that's again a problem. Profitless turnover, cashless profit, but in spite of bleeding financials, some of these companies have very, very high, skyrocketing, soaring valuations. Very important point to note here that in 21st century, the measures of corporate performance have changed. It is not only traditional profit sum ratios which you check out to find the performance of a corporate in the market. Today, the stakeholders of the company are actually looking for ability of the company to create value, ability of the company to preserve that value, and ability of the company to enhance that value going forward on a sustainable basis. That is what the stakeholders are looking for. Today, valuation is the key. Valuation is what the stakeholders are actually looking at. Ability of the company to be able to create value. And who are the stakeholders? Well, your investors, your shareholders, your financial institutions, bankers, your vendors, your customers, society at large, employees, government. All the stakeholders today are focusing on the value creation capability of the company. And that's why valuation is coming into the pivotal position, coming into the center of the entire functioning of the corporate world in the marketplace. Zomato came out with an IPO 3 years back. In the year in which Zomato came out with IPO, it had incurred a loss of 1,200 crores. At that point of time, Zomato had accumulated loss of 2,500 crores. But in spite of bleeding financials, such a bad financial condition, the IPO of the company was oversubscribed 37 times. That's because people looked at the future potential. People looked at and they decided to make investment in the shares of the company, which were priced at 76 rupees per share, based on their perception of the value that the company will be able to create for the stakeholders in future, in spite of very, very bad bleeding financial condition. Valuation, therefore, is the mantra that every corporate is looking for. You're trying to create value, preserve value, and enhance the value for those stakeholders. And by the way, how do you do that? How do you create value? You create value when you enhance your revenue, when you reduce your costs, when you improve the efficiency and effectiveness of your processes, when you enhance customer experience, when you are also able to take care of environment and society. While looking at your profits, the triple bottom line concept, people, profit, planet, is the focus for most of the modern companies in 21st century. We haven't lost the focus on profit. Profit has not lost its relevance. Profit and profitability are still important. But the path to profit passes through the lens of ESG. E for environment, S for society, G for governance. Environment, society, governance. While creating opportunities for maximizing profitability of your company, the companies are expected to be concerned about the environment. At the same time, you also have to take the responsibility of contributing towards the society. And your governance architecture has to be based on the tenets and principles of transparency, accountability, and fairness. And all these things will ultimately create value for the corporate which the stakeholders are expecting. So let me make it very clear right in the beginning of the sessions in this diploma course that valuation is an art as well as a science. Some people say it's not a science, but it is a science because there are certain universal principles of valuation which are applicable in all kinds of situations where valuation is required to be carried out. And it is an art. That is where a valuation professional actually applies those principles. That's where the art comes into play. A doctor has studied medicine science, but the time when he does surgery or the time when he treats a patient, that's where the art comes into play. The way he handles the patient, the way he handles the surgery is actually an art. Valuation is required for very many different purposes of very many different assets. You need to carry out valuation of land and building, plant and machinery, or maybe financial assets, valuation of inventory, valuation of debtors, valuation of shares and debentures and bonds. Valuation is all over. Let's talk basics. What is value and how can we determine the same? What is value and how can we determine the same? Let's talk about these three different elements: price, cost, and value. What is the difference between price, cost, and value? First important statement is value lies in the eyes of the beholder. That means two persons carrying out valuation of a particular asset or a particular business are most likely to come out with different estimates of value. Maybe within very, very close range, but it is highly unlikely that the value provided by the two valuation professionals of the same asset, same property is going to match. Very unlikely, highly unlikely. Value lies in the eyes of the beholder. There was that old man lying on the deathbed, and at that point of time, he had his son, aged about 55 years, standing beside him. And he said, "My time is over. I'm seriously ill. And the doctor says I'm going to die very soon. And in this last moment of mine, I want to give you a gift, my dear son." And he took out the wristwatch that he was wearing and gave it to his son and said, "This is my last parting gift. Anytime you find yourself in some kind of a financial problem, this watch is going to help you." And immediately thereafter, that old man passed away. This young fellow was doing pretty well in his career, and he just kept that watch in one of the lockers in the bank and forgot all about that. But life is not like barfi ka tukda. It's not always sweet. It always has its own topsy-turvy situations. Sometimes we are finding good times, sometimes there are bad times, and that happens with everyone without exception. After some years, this person found himself in some kind of a financial problem, And suddenly he remembered, wow, Papa had given me that watch, the last parting gift. Let me take that out and see how watch can help me tide over this financial problem that I'm facing today. He took out that watch. He went to a watch shop and said, I want to sell this watch. How much money can I get? And the shopkeeper said, Sir, this is a very, very old watch. I can maximum give you 500 rupees for this. Well, 500? My father said, this is going to help you in case of your financial problem. But here, this fellow is giving me just 500. One of his friends suggested, this is an English watch manufactured in UK. Why don't you write to the company and email? Maybe they will be able to offer you a better price for the watch. He wrote an email to the company and prompt came the reply, thank you so much for being our esteemed customer, very, very old customer, but unfortunately, we have stopped the manufacturing of this particular model of the watch. But being a very old esteemed customer, we offer you 5,000 rupees for the watch. Just 5,000? What is 5,000 in today's times? Not a very big amount, you know. He was very, very dejected. Then one of his friends suggested, well, there is a museum in the city where you are staying. Why don't you go to the museum and talk to the curator of the museum or the owner of the museum and show him this watch? He went to the museum the next day morning. As soon as the owner of the museum saw that watch, he said, wow, what an antique watch. And he immediately offered him 5 lakh rupees for that. Value lies in the eyes of the beholder. Same watch, 500 to 5,000 to 5 lakhs. I mean, that's actually what happens with regard to the valuation part of it. That valuation depends upon the person who is looking at that particular asset. Another way to explain this is very common water diamond paradox. Water diamond paradox. Water. What is the cost of a water bottle? 20 rupees, 50 rupees, 80 rupees, 150 rupees on the airport or 5-star hotels, whatever. Doesn't matter. Look at the usefulness of utility of water. A few drops of water can save your life. What is 150? What is 50 rupees? What is 20 rupees? Nothing. Look at the utility of water. Look at the value of water. Price is peanuts. On the other hand, when you look at diamonds, well, what is the price of diamonds? Huge. And what is the value? I don't know. End of the day, it's just a stone. It has different kinds of values, but end of the day, it's just a stone. So value differs from person to person, and value lies in the eyes of the beholder. That's the first important statement that you must understand and learn. So how is the price of a product determined? Price is determined based upon the negotiations. When you go to a market to buy a product and the seller says 100 rupees for that, 100 rupees is not a big deal in today's times, but you do not take out your wallet and straight away pay 100 rupees to the shopkeeper. You actually try to negotiate. Haggle with him. Baba, 100 rupees is too much. 80 hoga, 85, 90. You try to bargain. At what price you will be able to buy the product will actually be dependent upon the comparative bargaining power of buyer and seller. Maybe you may have to buy it at 100 rupees. He will not budge. Maybe you'll be able to buy it at 85, 90. But it all depends upon the comparative bargaining power of buyers and sellers. So price in any transaction, whether it is simply a case of going to the market to pick up some grocery item, or it refers to a business transaction of mergers and acquisitions, it is always determined on the basis of negotiations. I would like to introduce a case study here. This is Tata Chorus case study 2007-2008. Tatas were looking for acquiring a company in Europe in the steel segment, and they were scouting around for a good buy. After about 6 months of survey and study, they were finally able to zero in on Chorus Steel UK, the company they wanted to acquire, with a view to expanding their footprints in the European market. Tata Steel is a very big company, we all know. Huge capacity, huge turnover, huge number of employees. It's a very, very big company of India. But Chorus Steel of UK at that point of time was 4 times bigger than that of Tata Steel. It was 4 times bigger than that of Tata Steel in 2007. So a lot of rounds of discussion happened, and then there was negotiation going on in terms of the price. Tata's offered to pay a certain price. It was supposed to be an all-share deal where the company was proposed to be acquired by buying out the entire shareholding of the company, and they offered a price for buying out the shares of the company. The deal was almost through. Suddenly what happened? A company from Brazil jumped into the fray, and they also said, we want to buy Chorus, and they offered a better price, higher price for acquiring Chorus. Tata had spent a lot of time scouting around and finding a good buy. They did not want to let the company go out of their hands. They also offered a high price. Brazilian company once again offered high price. Finally, Tatas were able to buy Chorus Steel, but at a price which was almost about 40% higher than their original bid. You getting my point? They were able to acquire Chorus, but the price that they ended up paying was 40% higher than their original bid. And we all know that ever since Tata's acquired Chorus Steel of UK, the valuations of Tata Steel never really looked up because this was a wrong or a bad deal for them. If they had picked up that company at the original bid, it would have been a very, very good deal. But they ended up paying a higher price for the company, and that turned out to be a bad decision on the part of Tatas. Now, Tatas are trying to get rid of Chorus Steel. They're trying to sell the company out, but the company is so big, they are not able to find one single buyer who is willing to buy the entire company. Now the company is toying with the idea of splitting the company into different parts and then trying to sell it out in the marketplace. The message that we get out from here is always look at buying a good company at a fair price. Always look at buying a good company at a fair price rather than buying a fair company at a good price. Always try to buy a good company at a fair price rather than buying a fair company at a good price. That's where the Tatas made a mistake. They bought a fair company at a good price. They ended up paying a very high price, and that resulted in lack of value addition because of that acquisition on the part of the company. Then coming down to cost. Cost is very important from the seller's perspective. Any product, any asset, any business. At what price would you sell that product? You first have to be clear. What is the cost that I have incurred to create that asset? And once I've worked out the cost incurred to create the asset, then of course, I would like to have and get it topped up with some amount of profit. And that becomes my selling price in the marketplace. But the first point to note is, how do I get hang of what is the cost of creating an asset? Now, in the process of creation of any product or any asset, there will be number of activities which will be required to be performed. Each activity will consume resources. All those resources are going to cost you some money. So what I'm saying here, in the creation of any asset, you will have to perform a lot of activities. Each activity will consume some resources. And when you say consume resources, that means cost is going to be incurred. And that's how the cost built up is looked at as to what is the cost of creating an asset. That becomes important to the seller so that he doesn't end up incurring a loss by selling the product even below the cost of creating the sale. And that's where cost becomes important when you look at the valuation. Value? Yes. Value lies in the eyes of the buyer. Value lies in the eyes of the beholder. But basically, these 5 words, somebody who asks you what is valuation, if you understand these 5 words mentioned here in the circle below, you'll be able to explain to that other person. Value is a function of future benefits. If I acquire an asset today at a particular price, what is the benefit that I'm expecting to get, expecting to generate from that particular asset in future? That's what value is. Value is a function of future benefits. I'll give you more examples later on as part of my presentation. So, another important statement here, is price the same as value? If I pay 20 rupees for something, is it that I'm getting value 20 rupees out of that? No. There is no direct correlation between value. Remember, water diamond paradox. Water, very cheap, value very high. Diamonds, price very high, value, I don't know. End of the day, it's just a stone. Price is what you pay. Value is what you get. A quotation by Warren Buffett, way back, almost about 100 years back, but it's a prime quotation to explain the distinction between price and value. Price is what you pay right now to acquire an asset. And why do you pay that price? In the expectation of enjoying or benefiting from the benefits that are likely to accrue from that asset, from that product going forward. So, price, cost, and value. The price of any asset is determined based upon negotiations between the buyer and the seller. Cost is connected with consumption of resources because there are going to be various activities involved in the creation of an asset, and all those activities are going to consume resources, and the resources have cost. And value is the future benefits that are likely to be available to you. If you make an investment today, if you acquire an asset today, what is the benefit that you think is going to accrue to you? Suppose there is a stock in the market which has increased by over 70% in the last 6 months, and you've only been watching that. You have not purchased it so far, and it has gone up by 70% over the period of last about 6 months. Now, you have decided to purchase that stock and you're prepared now to place an order in the market when the market opens on Monday. Why? You have already missed the bus. The share price has increased by over 70% in the last 6 months. And you were not there. You haven't got any benefit. But the decision to buy the stock now is in anticipation of the future benefits. That is, you expect that the stock price is going to go up still higher. It has increased by 70% in the last 6 months, but it is likely to go still higher. And based upon the value that you think this stock will generate for you, or the future benefits that you will get by acquiring this stock now, you have decided to get into this stock or make investment in this particular company's share when the market opens on Monday. So the 3 factors that we discussed, price, cost, and value. Finally, the challenge of valuation is a challenge of integrating value, price, and cost. That's the tripod, and they are required to be integrated together with a view to understanding how value is determined for an asset based upon the dimension of price as well as based upon the dimension of cost. The challenge of valuation is a challenge of integrating value, price, and cost. Let's get down to the basic. This being the first session in the diploma course that you have joined, you're going to face some, technical terminologies also going forward. Some of the things are going to be a bit complicated also. But let's get down to the basics in this introductory session and think over, why does any asset have a value? Very basic question. Why does any asset have a value? And the answer is, an asset will have value if it fulfills the following 3 essential characteristics. Number 1, it must possess utility. Utility is a very basic and useful, important concept in microeconomics. All of us have studied basic economics in our school, college, professional times. Anything which has utility will have value, usefulness. A glass has a utility so that you can drink something with the help of glass. A pen has a utility so that you can write out something with the help of pen. Furniture has a utility used for sitting purposes. Any product or asset which has some kind of a utility is going to have value. And vice versa. If there is something which is not having any utility at all, that will not have any value. So the same statement in positive and negative. The second important requirement is, in order to have value, an asset must be scarce. Scarcity creates value. Gap in demand and supply. If there is no scarcity of a particular product, probably it will not have value, or if it will not have very high value. A company in China has come out with a very, very novel idea. They are selling fresh air filled up in canisters. Yes, Chinese company is selling fresh air. Well, you can say, who will buy fresh air? It is a gift of nature available to all of us on the planet. Why should somebody pay a price for fresh air? Well, yes, Air is gift of nature to all of us, freely available, abundantly available. But the fact of life is most parts of the world on this planet have polluted air. The degree varies. At some places, pollution level is higher. At some places, pollution level is lower. But most parts of the world have polluted air. So, people are willing to pay a price for a whiff of fresh air. And that's what this Chinese company is capitalizing on. What they do, they go to Alps mountain in Switzerland and they fill up the canisters with fresh air and they sell it out in the marketplace. It is selling like a hotcake in the European market. I'm sure they're going to hit the Indian market also very soon in near future. Like we buy water bottles, in future we may also buy canisters of fresh air. The third characteristic for any asset to have value is it must be marketable or transferable. If you have something which, because of certain restrictions, maybe court restrictions, legal restrictions, some other reason for that matter, you have that asset, but you can't transfer that asset to someone else. You can't sell it out because of some restrictions. Then it will not have any value. An asset will have value only if it can be sold, transferred, marketed. If you have an asset and because of certain restrictions, you're not able to transfer or sell that asset, that means there's no value of this asset for you. So the answer to basic question, why an asset has a value, any asset would have value if it fulfills the following three essential characteristics. It must have utility, it must be scarce, and it must be transferable, saleable from one person to another person. So let's orient our minds now to valuation. What is valuation? Valuation is a process of finding value of an asset. It's a process of estimating the potential worth of an asset or a business. Potential worth. Potential means future. And therefore, please also remember this important statement right in the beginning of this diploma course session. Valuation is all about the estimated potential worth of an asset. Valuation is all about future benefits. And therefore, valuation is all about a matter of hope. You hope that this particular item, if you purchase today, is going to give you benefits in future. It may not. But then there is always that element of hope that you depend upon. Valuation is all about hope because you are looking at the estimation of future benefits or estimation of potential worth of an asset or a business if you decide to acquire that asset or business today. So value is monetary worth of future benefits one is going to have from an asset. What is the value of an asset for a particular person? It has a lot of benefits for me. It will provide me a lot of benefits in future. Well, this kind of statement will not work. You actually have to convert your expectation in terms of rupee value, rupee numbers. What is the monetary worth? How many crores, how many lakhs, how many thousands? Whatever benefits you are expecting to generate or derive from an asset in future, You got to convert them and look at their value in monetary terms. And that's what value is all about. Value is monetary worth in rupee terms of the future benefits you are expecting to get by acquiring an asset today. And that's what valuation is all about. Valuation or value depends upon who is determining the value and for what purpose. Valuation is required by companies. Valuations are also required by partnership firms. Valuation is also required by investors. Valuation is also required by Hindu undivided families, descendants. When the legal heirs, descendants of Hindu undivided family, decide to take away their share, at that point of time, the HUF property is required to be valued. Similarly, in the case of a partnership firm, at the time of dissolution of a firm or admission of a new partner, partnership assets may have to be valued. Investors carefully look at the valuation when they decide to make investment in stock market. They are carefully looking at investment value, not only stock market. If you decide to make investment in gold, in jewelry, in old art, in real estate property, we're looking at value. Sellers and buyers are obviously concerned about the value, and valuation is also important from the perspective of employees of the company. That's because many companies today offer ESOP, ESOP, Employee Stock Option Plan. Many a time, many companies today in the marketplace, instead of giving cash increments, they provide bonus increment to their employees in the form of ESOP. They provide shares of the company at a certain price. How the pricing of that share is required to be done at that point of time, that is based upon SEBI formula and SEBI regulations. And all of you are capable of doing the same. All of you would become competent to handle that kind of assignment once you complete this diploma course. So SEBI requires the valuation of ESOPs to be carried out by following their guidelines and also by applying the particular formula for pricing of shares provided by SEBI. And therefore, value depends upon who is determining the value and for what purpose. So valuation or value depends upon who is doing valuation. No two valuation professionals are likely to come out with the same valuation estimate for the same asset. They're going to come out with different numbers. Of course, within a limited range, within a given range. But the estimates of value provided by the two valuers are very unlikely that they will match. Value also depends upon why valuation. Are you carrying out valuation of a business as a going concern in the context of mergers and acquisition? Your purpose is different. Or you're valuing a business in the case of the company going out of the market. That's in the case of liquidation, winding up of the company. Your purpose objective is entirely different. So the value also depends on the purpose and objective of valuation. That is the why part of it. Why valuation? And third important point on which the value depends is the timing. When the valuation is being done. If you compare the valuation of any company today and compare that with the valuation of the same company in pre-COVID times, the valuation is going to be significantly different, either on the upside or on the downside, depending upon how that particular company was impacted by COVID-19 pandemic situation. COVID-19 pandemic negatively impacted many of the businesses. But COVID-19 pandemic also had positive effect, positive impact on some of the businesses, some of the sectors. So depending upon which particular sector you are looking at, which particular business you are talking about, the value of the company today as compared to the value in pre-COVID times will be either higher or lower because of the timing difference. So the third critical aspect on which the valuation depends is the timing. If you do valuation of a business now, it will give you some estimate. And if you do the valuation 2 months later, it will throw up a different valuation estimate. And a valuation of a business done 2 months before will again carry a different estimate. Timing is very critical in the whole ball game of valuation. So there are different concepts of valuation. Value may be different for different purposes. Value could be considered as fair market value, fair value, intrinsic or fundamental value, investment value, synergistic value, special value, liquidation value. Let's have brief discussion on each one of these concepts to understand what are these different connotations or concepts of valuation and value. What is fair market value? It is an estimate of the market value of an asset based on what a knowledgeable, willing, and unpressured buyer would pay to a knowledgeable, willing, and unpressured seller in the market. That means fair market value is the price at which an asset would get exchanged between a buyer and a seller, and both buyer and seller are supposed to be knowledgeable. They have full information about the product. They have full information about the market. They have full information about the competition. They're fully aware about just about everything connected with that particular product. Both buyer and seller have to be willing to enter into a transaction. They must be serious to do a deal. And then third important element is there should be no pressure either on the buyer or on the seller to get into a transaction, and they're doing it willingly without any kind of a pressure. That means we're looking at a situation where there is a transaction happening in the marketplace between a buyer and a seller as per the normal market forces, with there being complete information available with both buyers and seller. Both of them are willing to enter into a transaction, and both of them do not have any kind of pressure on them. The price at which the asset would be exchanged between the buyer and the seller in such kind of environment is what is called the fair market value. So we can use the term here. It is the market price. Fair market value is the market price which is determined by using the arm's length principle. I mean, we are not hand in glove. Both the buyers and seller, they're acting in their own individual interest. And they're acting with full knowledge, willingly, without any kind of a pressure. So this transaction is technically known as arm's length transaction. It is called a fair market price because having a transaction at this value, neither the buyer nor the seller is going to gain abnormally at the cost of the other. So what I'm saying here is, it's going to be a win-win situation for both the buyer and the seller, not win-loss, but it's going to be a win-win situation. Both of them would be happy. Seller would be happy with the price that he would have got for the asset. Buyer would be happy for the price that he would have paid for buying that asset. Because it's a fair market price, both of them are satisfied with the transaction. Nobody has gained abnormally over the other. It's not a win-lose situation. It's a win-win situation for both the buyer and the seller. What is the fair price? Fair value. Fair value is the price that would be received by selling an asset in an orderly transaction between market participants at the measurement date. Fair value is the price which arises out of a structured, orderly transaction between the market participants, nothing personal. It happens in the market. And last words are very, very key and important. Valuation is always determined with reference to a particular date, which is called the valuation date. Like in the case of financial statements, when you prepare a profit and loss account, which tracks and takes into account the revenues and the expenses of a particular financial year, the 12-month period, and then gives you indication of profit or loss end of the year, a balance sheet is always prepared as on a particular date. 31st of March every year, end of the financial year. What is the position of assets and what is the position of liabilities of the company as on 31st of March? If you prepare the balance sheet of the same company on 30th of March or 1st of April, it's going to give you a different picture of the assets and liabilities. Similarly, in the case of valuation, any asset that's required to be valued has to be valued with reference to a particular date, which is called the valuation date. The measurement of fair value is a hypothetical transaction. Many a time, you are required to carry out valuation of asset now on 7th of September by taking cutoff valuation date as 5th of May, 5th of June. Yes, there are situations practically under IBC as well as under various other laws where the valuation date may be a few months prior to the date when actual valuation is being carried out. So, it is a hypothetical transaction. We have to make an estimate if this asset was to be transacted between a buyer and a seller as on 5th of June 2024, what would have been the transaction price? The three key elements of fair value are: there must be a current exit price, the asset must be transferred or sold in an orderly market-based transaction, and the transaction must be between the market participants, nothing personal, in the sense the transaction should not be between the private parties. Intrinsic value, also called book value, is the true value of a company or an asset based on an underlying perception about the future benefits that are likely to arise out of that asset or business, both tangible as well as intangible benefits. How do you find out the book value of a company? Well, if you use a simple formula, profit after tax divided by number of equity shares of the company will give you book value. Intrinsic value is the true value of a company or an asset based on an underlying perception about the future benefits from all aspects of the business in terms of both tangible and intangible. You can also check out PE ratio, price to earning ratio, PAT divided by number of equity shares, and you can also work out the book value. Maybe you can also check out various other indicators. You can look at the total asset value of the company divided by number of equity shares, book value. But then, of course, you have to be careful. The company would also have certain liabilities. You got to consider net assets only with a view to working out the book value of the shares of a company. The value, intrinsic or book value, may or may not be the same as the current market value. The book value of a share could be 32 rupees, and it may actually be going in the market today at a price of 40 rupees or 25 rupees. If it is selling in the market at 40 rupees today, we say the share price is overvalued because the book value is 32. And if the share price is 25, we say the share is undervalued because inherently intrinsic value of the share is 32. It is going in the market at 25 today. That means the share is undervalued. It has a potential of increase in the share price. It's probably considered as a good buy at this point of time. It is a true worth of the asset. Then you have investment value concept. Investment value is the value of property to a particular investor. And this value changes from investor to investor. Let me give you an example. A company purchased a piece of plot costing rupees 4 crores in 2019 in pre-COVID times, as the company was looking for putting up a new factory. Suddenly, COVID-19 pandemic happened. Now that the company has recovered in 2024, they are no longer interested in putting up a new factory because they have been hugely negatively impacted by COVID-19 pandemic situation. And the company has decided to sell this piece of land that they had purchased in 2019 at 4 crores. So the administration manager of the company was told to look out for the buyers. We want to sell this piece of plot. It doesn't happen overnight. Property deals don't happen overnight. They take time. He had been trying for the last few months. 2 months back, there was a buyer who offered a price of 3 crores 85 lakhs. Last month, someone came who offered a price of 4 crores 15 lakhs. 15 days back, someone offered a price of 4 crores 20 lakhs. And yesterday, somebody came to office and offered a price of 4 crores 50 lakhs. 385, 415, 410, 420. And somebody came to meet the admin manager yesterday and he offered a price of 4 crore 50 lakhs. Why sudden jump? So much of jump in the price being offered by a particular investor. The admin manager started making inquiries. And he found out that the reason why this particular investor is offering a price of 4 crore 50 lakhs way above the price being offered by other investors is because this particular investor has adjoining plot already with him. वो साथ वाला प्लॉट ऑलरेडी उसका है, ये प्लॉट भी मिल जाएगा. It is going to be very, very advantageous for him, and that is why he is willing to offer higher than normal price or higher price as compared to what is being offered by other investors. And that's called investment value. He looks value in that. The person who is offering a price of 4 crore 50 lakhs is looking at value. I already have 400 square yards plot. This is another 400 square yards plot. If I buy this out, I will have an 800 square yard plot at one single location. It's going to be advantageous for him. Investment value changes from investor to investor. Somebody offered a price of 385. Someone offered a price of 4 crores 10 lakhs. Someone offered a price of 4 crores 20 lakhs. And then we have this investor who is offering a price of 4 crores 50 lakhs. That's the concept of investment value. Investment value reflects the value of an asset depending upon his expectations and requirements. How much benefit will I get by acquiring this asset today, by acquiring this property today, by making an investment today? It reflects the perception and expectations of different investors. And that's why I said investment value differs from investor to investor. It may be possible that market value of an asset may be steady, uniform, not much of a change. But the investment value is unpredictable and is completely dependent on the potential buyer. Look here, somebody came just from out of the blue moon, offered a price of 4 crore 50 lakhs, whereas the company earlier had offers only maximum offer of 4 crore 20 lakhs. So this is unpredictable. Somebody may offer a higher price depending upon his perception of what kind of benefits, what kind of value he'll be able to generate by acquiring that asset at that particular offer price. Then you have synergistic value. What is synergy? Synergy is 2 plus 2 is equal to 5. Yes, I'm not getting my maths wrong. Synergy is 2 plus 2 is equal to 5. That means when you combine two things together, and if you get the value higher than their simple algebraic sum, that is the result of synergy. If one company which has a turnover of 50 crores acquires another company by way of mergers and acquisition which has a turnover of 30 crores, the basic objective of mergers and acquisition would be the turnover of the combined business after completion of M&A transaction should be more than 80 lakhs. Then only it is beneficial. Otherwise, let the two businesses keep on running as independent entities. Why should you look at merger and acquisition if you don't expect any additional benefit by combining the two businesses together? So, when you combine two assets, when you combine two businesses together to create a new asset or a new entity or a new business, the new business should have, ideally should have, a higher value than the sum of individual assets, and that's called synergistic value. Normally, the concept of synergistic value is dealt with and talked about in the context of mergers and acquisitions. I've already discussed the case study of Tata Poros 2007 with you in the context of synergistic value. Special value. The special value basis captures the set of characteristics that make the business or its assets valuable to a specific investor Remember that anecdote of watch. That curator of the museum, owner of the museum, offered him a price of 5 lakh rupees for that watch. Earlier, he had got offers of 500 rupees and 5,000 rupees. Because that curator of the museum thought that this was a very, very old, precious, antique watch. And thus he was willing to pay a very high price for the same, because for him, the watch was very, very valuable, being antique watch. But for the other two people, the watch did not carry so much of value. Special value is attributable to specific investor. Based upon certain characteristics of the asset, a particular investor may consider to pay a higher price for an asset because of his perception of, or because of his estimation of the value that the asset carries going forward into future. Normally, this is the value offered by a seller in negotiation depending upon the client or the customer. Liquidation value. Liquidation means the company is going to go out of business. It is not likely to maintain its going concern status anymore. Another word used for that is winding up, but actually winding up is a pre-process. Winding up is just a process of closing down a company. The company actually gets out of the market finally when it is liquidated. The liquidation value is the amount that would be realized when an asset or group of assets are sold without consideration of the benefits associated with a going concern business. In accounting, we have a very, very basic concept, going concern concept. That means accounting is done on the basic assumption of the business will continue in the market for an indefinite period of time. And that's the assumption on the basis of which entire accounting is done from the company's perspective. But many a time what happens, the companies get into problem, the companies get into distress, and thus the companies at that point of time are required to go for winding up, and they are then required to liquidate all their assets, sell all their assets, get the money, and then use the money for paying out their various liabilities, secured creditors, unsecured creditors, government dues, workman's salary for a certain period of time, unsecured creditors, equity shareholders, preference shareholders, government taxes, things like that. So liquidation value means the value that can be generated by selling the assets of the company when the company has gone into the process of winding up or liquidation. There can be basically two ways in which the assets of the company could be sold. When a company gets into liquidation, you may go for lump sum sale. That means you decide to sell all the assets of the company as a parcel, as complete one lot in one go. Or you may decide to sell the assets of the company in different lots, in different stages. Of course, in the second case, you will get better value. You decide to sell part of the assets of the company now, and then you wait for a good buyer, and then you may decide to sell the other part of the company's assets maybe 2 months later, 3 months later. You will probably realize better value. Liquidation value is the value that would be realized when an asset or group of assets are sold without consideration of benefits associated with a going concern business. the normal assumption that we have in accounting and business in general is going concern concept. That means once a business is set up, it is likely to continue in the market for an indefinite period of time. That's the assumption on the basis of which the entire accounting of the company is maintained and all operations of the company are carried out. But liquidation value is the amount that would be, sorry, I was talking about the earlier one. I was talking about, just a minute, please. So that was the liquidation value. So value may also be different for different purposes. We can have fair market value. We can talk about fair value. We can look at intrinsic and fundamental value. We talk about investment value. And we also look at synergistic value or special value. What is the concept of fair market value? It is an estimate of the market value of an asset based on what a knowledgeable, willing, and unpressured buyer would probably pay to a knowledgeable, willing, and unpressured seller in the market. Fair market value, FMV. The important characteristics are, or the important elements of fair market value are, both the buyer and the seller have to be knowledgeable, willing, and unpressured. They must have full knowledge about the characteristics of the asset. They must have full knowledge about the market. They must be willing to enter into a transaction. And there should be no pressure either on the buyer or on the seller. They can take a call based upon their objectives, based upon their understanding. There is no pressure on either one of them. And that's what is called the fair market value. It is the market price, fair market value, FMV, is the market price, which is...
So sorry to interrupt. We
Yes,
already
please.
did this, sir. So we already did this. So
I
it's a
think we have already
repetition.
covered this slides. You have moved backward. You have to move forward, sir.
Yes, sir. Yes, sir. We already did this, sir. We did till liquidation value, sir.
Okay, fine.
Yeah.
Yeah. Fine.
This
Now
is not
coming
covered.
to
This is not-
replacement value. Fine. This is what we have done, liquidation value. Fine. Replacement value is the total cost of replacing an asset, generally in its present form and in accordance with appropriate regulations and legal requirements. What is the cost of replacing an asset? More or less in the same situation with same kind of characteristics. What is the cost at which the asset can be replaced? And that's what is called the replacement value. Total cost of replacing an asset in its present form, but of course in accordance with appropriate regulations and legal requirements. While calculating replacement value, you got to take into account allowances for professional fee. You must also consider factors related to construction of a replacement asset, which may include demolition, debris removal, and some other factors. So, sorry, I'm in some other slide for that matter. I think the last two slides here before we end the session for today. Liquidation value is the amount that would be realized when an asset or group of assets are sold without consideration of benefits associated with a going concern business. That means the company or the business is going to be liquidated. At that point of time, all the assets of the company may be sold out. Probably you can go and follow two different approaches for sale of assets in the case of liquidation. Either you can go for slump sale, selling out all the assets of the company in one go as one parcel, or probably you can go for piecemeal sale when you decide to sell part of the assets now and then wait for the right time and then sell the other part of the assets. By that approach, possibly you would be able to generate better value out of those assets. But liquidation value refers to the amount that would be realized when an asset or group of assets are sold without consideration of the benefits associated with a going concern business. That means if the business is not likely to remain as a going concern and the business goes into liquidation, how much value do you expect to derive by selling the assets in the marketplace at that point of time? So the basic assumption while calculating liquidation value is the asset or the business is no longer going to be a going concern. The life of the asset or life of the business is over, and thus it is required to be liquidated, and thus the value that it will fetch in the marketplace is called the liquidation value. Similarly, you have the concept of replacement value. Replacement value is the total cost of replacing an asset in the present form in accordance with appropriate regulations and legal requirements. If you already have an asset, you want to replace it, how much would it cost? Comparatively speaking, more or less in the same form, same substance, same kind of capacity of the machine, whatever, what is the cost that's going to be incurred? Of course, allowing for and providing for professional fee in the case of tangible assets. Consider factors related to construction of replacement asset, which may also include demolition, debris removal, and other factors. Replacement cost is the total cost of replacing an asset, generally in its present form, in accordance with appropriate regulations and legal requirements. So what valuation is all about? Valuation is not only about numbers. The estimate of valuation depends upon the kind of assumptions that you make before you carry out the valuation exercise. You got to exercise your judgment. Gut feeling plays a very important role. And of course, there is a lot of hunch involved while carrying out valuation. Valuation goes beyond financial capital. Besides financial capital, we also talk about different forms of capital like human capital, environmental capital, relational capital, social capital, manufactured capital. So valuation of an asset goes beyond financial capital. It is the ultimate integrated effect or impact on the overall valuation of an asset or a business. The key to measuring corporate performance is the ability of the company to create value, to preserve value, and enhance the value sustainably. That's what valuation is all about. How do you identify and manage and measure ability of the company to create value, preserve that value, and enhance that value going forward on a sustainable basis? Value lies in the eyes of the beholder. That means every person is going to have a different value attached or attributed to a particular asset. It is slightly subjective, and therefore value lies in the eyes of the beholder. For the same asset, someone may be willing to pay a given price, someone may be willing to pay or offer a different value depending upon what is the importance, significance, and utility of that asset for a particular person. Valuation is an art and a science. It is a science because it is based upon certain fundamental principles on which valuation is carried out. And it is an art also because how you apply those principles is what is the art that is exercised by the valuation professional. That's why we say valuation is both an art and a science, yes, but actually it is more of a craft. How do you apply the various principles of valuation to carry out valuation? That's what is more of a craft rather than looking them in isolation as either art or a science. And valuations are temporary, values are permanent. This is the key statement here. That means valuations of the businesses may go up and down depending upon the changes taking place in the business environment and the business operations of the company. But what is most important for staying afloat in the market on a sustainable basis and creating value continuously for the stakeholders is that you got to stick to your values. Values are permanent. Valuations are temporary. That's the key aspect to remember. You must always look at creating value within your business based upon tenets of ethics and based upon ethical principles. That's what is going to take you far off in your business model and business venture rather than trying to make a quick buck. That's not going to help you in the long run. And that's what valuation is all about. So we close this session here today, having given you a brief, broad introduction with regard to different concepts of valuation. Going forward, we're going to deal with each one of these concepts and some of the new concepts going forward. How do we really apply them in real life? How do you put them into operation? How do you actually carry out valuation of different companies? That's what we're going to talk in going future in further sessions. Thank you so much for joining us, and we close the session here today. We'll be sharing the presentation through a WhatsApp group, which we are going to create immediately after this session so that everyone can get access to that particular presentation or the PPT. Look forward to your future sessions and having you in future sessions. Thank you so much. Namaskar.
Thank you, sir.
Namaste, sir.
Yes, please.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Hello,
Thank
sir.
you, sir.
Thank you so much, sir.
Thank you, madam.
Thank you, sir.
Thank you, sir.
It was really nice.
Thank you.
Thank you so much, sir.
Thank you, sir.
Thank you, sir, for valuable inputs.